Disclaimer.
Gentlemen, today is January 13th, 2026, and the world has just been shaken. What we have been warning about for months has finally happened. Paper, silver, and physical metal have officially parted ways. While banks are struggling to keep the price at $85 on your screens, the real metal on the streets of the United States has just broken through $100 an ounce. This is not just volatility. This is a complete surrender of the system. The main trigger? The Department of Justice has just filed criminal charges against Jerome Powell. The Fed is hostage, and the 356-to-1 paper scam has just detonated. Today, I will show you internal documents that explain why the banks will no longer be able to close their holes. Pandora's box has been opened. If you don't manage to convert paper to metal now, you will have neither tomorrow. Watch until the end. Time is running out. Something broke in our financial system on January 11th, 2026. And if you're holding paper-silver contracts right now, you need to understand what just happened. The Department of Justice served Federal Reserve Chairman Jerome Powell with criminal grand jury subpoenas over his congressional testimony, and at the exact same moment, physical silver vaults across America started emptying faster than anyone thought possible. This is not coincidence. This is the unraveling of a pricing mechanism that has been hiding the real value of silver for decades. Why is physical silver worth $15 more than what you see on your monitors? The answer is a number that banks have been hiding for decades: 356-to-1. For every ounce of real silver in COMEX vaults, banks have issued 356 paper promises. It was a perfect game until the Justice Department got involved. Today's attack on Powell is not just politics. When the Fed chairman is criminally prosecuted, market-making algorithms go haywire. Banks can no longer use their unlimited leverage to drive down the price. Their magic formula of printing paper to suppress the metal has just been turned off. The result? A silver divorce. Panicked institutional players are demanding physical delivery, but when 356 owners claim the same bar, the paper price becomes meaningless. That's why you see $85 on the screen, but you can't buy a coin for less than $100 from any dealer in America. This is the beginning of a short squeeze of epic proportions. The 8 largest banks are now trying to close their positions, but there is simply no silver. They are cornered by the DOJ investigation, and every minute of delay is costing them billions. Here's what should grab your attention. While your screen shows silver trading at $85 per ounce, walk into any major bullion dealer in America right now and try to buy a silver eagle. You'll pay $92 to $100 for that same ounce. That's not a small markup. That's a 15-20% premium. And it's the widest gap between what the market says silver costs and what you actually pay to hold it in your hand since the Hunt brothers tried to corner the market in 1980. Think about that for a second. The official price and the real price have divorced, and they're not getting back together. I watched this unfold in real time, and the speed was stunning. On Friday, January 10th, you could still find silver eagles at major online dealers like Apimex and SD Bullion for around $88, which felt expensive but manageable. By Sunday night, those same dealers had sold out completely or were showing call for pricing on their websites. Monday morning, the dealers who still had inventory raised their premiums to levels I haven't seen in my entire career covering precious metals. JM Bullion was quoting $97 for eagles, and smaller regional dealers were hitting $100 or more. The physical market didn't just move, it ran. What makes this different from every other silver rally you've seen is that the disconnect happened simultaneously with the Powell subpoena news. The Department of Justice isn't playing around here. According to multiple reports from Bloomberg and the Wall Street Journal, the grand jury subpoenas focus on whether Powell misled Congress about the Fed's emergency lending facilities and their coordination with the Treasury Department during recent banking stress. This is not a political theater investigation. Criminal grand jury subpoenas mean prosecutors believe they have evidence of potential crimes, and they're compelling testimony under oath with criminal penalties for lying. You might be wondering what a Fed chairman's legal troubles have to do with silver prices. Here's the connection that most financial media is missing completely. The Federal Reserve's credibility is the bedrock underneath every paper contract, every futures market, and every derivative that promises to deliver physical assets later. When that credibility cracks, investors start questioning whether the paper promises they're holding will actually convert to real assets when they need them. And silver, more than almost any commodity, has an enormous paper-to-physical ratio that makes it vulnerable to exactly this kind of confidence crisis. Let me put this in perspective for you. The Shanghai Gold Exchange reported physical silver premiums hitting 12 to 13% over spot price in the first week of January, which already signaled that Chinese buyers were losing faith in paper pricing. But then, Japan's situation exploded into something nobody expected. According to precious metals tracking service Kitco, Japanese dealers were reporting premiums as high as 80% by January 12th, meaning buyers in Tokyo were paying around $130 per ounce for physical silver, while their screens showed $85. That's not a market functioning normally. That's a market where paper prices have completely lost their connection to physical reality. The timing matters enormously here. On January 1st, 2026, China implemented export restrictions on refined silver as part of their broader critical minerals policy. The Chinese government, which controls approximately 65% of global refined silver production through their processing facilities, essentially locked down the supply chain. The official language talked about strategic resource management and ensuring domestic supply security, but the practical effect was immediate. Chinese refined silver stopped flowing to Western markets at anything close to previous volumes. The Shanghai Futures Exchange saw immediate tightness, and that pressure rippled across the Pacific within days. Now we're watching American dealers scramble to source inventory from anywhere they can find it. The refiners are running at full capacity, but here's what most people don't realize. There's a significant time lag between mining silver ore and producing finished coins or bars that retail investors can actually buy. The Royal Canadian Mint produces silver maple leafs, the U.S. Mint produces silver eagles, and various private refiners produce generic rounds and bars, but they all need refined silver as feedstock. When China restricts exports of refined material, that entire supply chain tightens almost immediately. The premiums you're seeing aren't just about demand. They're about genuine scarcity of deliverable product. The COMEX futures market, where most paper silver trading happens, is showing something extraordinary right now. Open interest remains elevated, meaning traders are holding huge positions betting on silver prices, but the registered inventory, the silver actually available for delivery to settle those contracts, has been declining steadily. According to data from the CME Group itself, registered silver inventories have dropped significantly from their 2020 peaks, creating a situation where the ratio of paper claims to physical ounces has stretched to dangerous levels that historians of commodity markets recognize as pre-squeeze conditions. Here's where it gets really interesting for you as someone trying to protect your wealth. The institutions are moving first, and they're moving aggressively. Major investment banks and hedge funds have been steadily standing for physical delivery on their COMEX contracts, rather than rolling them forward or settling for cash. That's unusual behavior, because taking physical delivery is expensive and logistically complicated compared to just trading the contracts. When sophisticated players start demanding real metal instead of paper promises, they're telling you something important. They do not trust the paper market to maintain its peg to physical reality. Morgan Stanley just flipped their entire commodities outlook in a research note that landed on institutional desks on January 10th, one day before the Powell subpoena news broke. Their commodities team, which had been relatively cautious on precious metals through 2025, suddenly told their institutional clients to stick with metals, and specifically highlighted silver as a fiscal risk hedge. The timing is remarkable, and it suggests that major Wall Street institutions saw this decoupling coming before the DOJ news made it obvious to everyone. These firms employ hundreds of analysts and have access to order flow data that reveals what the big players are actually doing with their money, not just what they're saying publicly. The traditional financial media is calling this a premium spike or a temporary supply disruption, which fundamentally misses what's happening. This is not a supply disruption in the normal sense. It's a discovery that the price discovery mechanism itself has been broken. For decades, the paper silver market has set the price that physical dealers then use as their benchmark, adding small premiums to cover their costs. But when physical premiums explode to 15, 20, or even 80% above spot, the paper price stops being a useful reference point. It's like having a thermometer that says it's 70 degrees outside while you're literally watching ice form on your windows. The instrument has lost its connection to the reality it's supposed to measure. This matters for your retirement account, your savings strategy, and your understanding of what comes next in our financial system. The Fed's independence, which Powell has defended as sacred throughout his chairmanship, is now under criminal investigation. The largest industrial and monetary metal after gold is experiencing a physical paper divorce that has only happened twice before in modern history, and both of these things are happening simultaneously while China has locked down the primary supply chain. If you think these are three separate stories, you're missing the systemic crack that's opening right in front of us. The Hunt brothers tried to corner silver in 1980 using borrowed money and aggressive futures buying. The exchange changed the rules, raised margin requirements, and crushed their position. But this time, the demand is coming from everywhere at once. Sovereign wealth funds, central banks, retail investors, and industrial users all competing for a shrinking pool of physical metal while paper contracts multiply exponentially. There's no single player to target, no coordinated position to unwind, and no clear mechanism to force everyone back into paper. The divorce has been filed, and there's no going back to the way things were. Let me show you the hard data that proves this is not just another price spike. This is a structural breakdown that's been building for years and just reached its breaking point. The CME Group, which operates the COMEX exchange where most silver futures trade, publishes daily inventory reports that most retail investors never look at. These reports separate silver into two categories: eligible and registered. Eligible silver is stored in COMEX warehouses, but not available for delivery against futures contracts. A registered silver is the metal actually pledged to back those paper contracts, the silver that futures holders can demand when they stand for delivery. Here's the number that should make your blood run cold. According to CME data, registered silver inventories at COMEX have collapsed by approximately 70% since their 2020 peaks. We're talking about a drop from over 150 million ounces, down to roughly 45 million ounces of registered inventory as of January 2026. Meanwhile, open interest, the total number of outstanding futures contracts, has remained elevated or even increased during certain periods. Each standard COMEX silver contract represents 5,000 ounces, and when you do the math on the total notional silver represented by open contracts versus the registered physical silver available for delivery, you arrive at that 356 to 1 ratio that sounds impossible until you see the official data yourself. Think about what this means in practical terms. If you own a futures contract that gives you the right to demand physical silver delivery, you're in a room with 355 other people who have the exact same claim to the same ounce sitting in a vault. This works perfectly fine, as long as everyone agrees to play the paper game, rolling contracts forward, settling in cash, never actually demanding the metal. But the moment a critical mass of contract holders decides they want physical delivery instead of paper promises, the entire mechanism seizes up like an engine running without oil. That critical mass is happening right now, and JP Morgan is leading the charge. The bank's commodities division has been standing for maximum physical delivery on their silver contracts throughout 2025, and the trend accelerated dramatically in December and early January. Industry analysts who track COMEX delivery data, including the team at TF Metals Report, have documented JP Morgan taking delivery of millions of ounces while simultaneously appearing to reduce their short positions in the paper market. This is significant because JP Morgan was historically one of the largest short sellers of silver futures, a position that made perfect sense when they could always source physical metal easily. Their pivot to demanding delivery and covering shorts signals they have seen something in the supply chain that changed their entire risk assessment. The institutional world operates on information that flows weeks or months before it reaches retail investors. And last week, we got a glimpse of what the big players have been preparing for. On January 10th, remember, this is one day before the Powell subpoena news broke, Morgan Stanley's commodities research team published a note that represented a complete reversal of their previous positioning. For most of 2025, Morgan Stanley had been relatively cautious on precious metals, recommending tactical positions but nothing aggressive. Their January 10th note told institutional clients in clear language to stick with metals, and specifically identified silver as a fiscal risk hedge that investors should be overweight. The timing is remarkable, but the language is even more revealing. Morgan Stanley's research doesn't typically use urgent language. These are carefully worded documents designed to guide billion-dollar allocation decisions without triggering panic. But this note specifically highlighted deteriorating fiscal credibility and potential monetary regime instability as key drivers for precious metals exposure. They weren't talking about inflation or industrial demand. They were talking about systemic risk to the monetary system itself. When a major Wall Street bank starts telling its institutional clients that the fiscal and monetary regime might be unstable, that's not investment advice. That's a warning siren. Within 24 hours of the Powell subpoena news breaking, we saw something even more extraordinary. Former Federal Reserve chairs and Treasury secretaries, people like Janet Yellen, Ben Bernanke, and former Treasury officials from multiple administrations, issued a joint statement condemning the DOJ investigation as a threat to Fed independence and monetary stability. The statement, reported by the Wall Street Journal and Bloomberg, didn't just defend Powell personally. It explicitly warned that criminal prosecution of a sitting Fed chair for testimony to Congress creates unprecedented uncertainty in global financial markets and could undermine confidence in the dollar's role as reserve currency. Read between those lines, and you'll see exactly what's happening. These former officials aren't worried about Powell personally. They're terrified about what happens when the world realizes the Fed chairman might go to prison while the central bank is still supposed to be managing monetary policy independently. Foreign central banks, sovereign wealth funds, and institutional investors all operate on the assumption that the Federal Reserve is politically independent and credible. When that assumption cracks, money starts moving out of dollars and into hard assets at a speed that can overwhelm markets. Let me show you what's happening in the vaults right now, because the data is stunning. According to tracking by precious metals analyst Steve St. Angelo, who monitors COMEX warehouse receipts daily, we're seeing outflows of registered silver that accelerated dramatically in the first 2 weeks of January 2026. We're talking about multiple millions of ounces leaving registered status every single day, either moving to eligible status or leaving COMEX warehouses entirely. This is metal that was backing futures contracts, suddenly becoming unavailable for delivery, which mathematically increases the paper-to-physical ratio even further and makes the entire structure more fragile. The Bank for International Settlements, which serves as a central bank for central banks, publishes quarterly data on derivative positions held by major financial institutions. Their most recent report, covering positions through late 2025, showed that the 8 largest banks in the world hold enormous concentrated positions in precious metals derivatives. These positions are described in the report using notional values that run into hundreds of billions of dollars. But what matters is not the notional value. It's the directional exposure and whether these banks are hedged properly for a physical delivery squeeze. Based on the price action we're seeing and the premium explosions in physical markets, the answer appears to be no, they are not adequately hedged. Here's where history becomes prologue, because we've seen this playbook before. In 1980, the Hunt brothers, Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market using borrowed money and aggressive futures buying. They accumulated enormous positions in COMEX silver contracts and started taking physical delivery, which drove prices from around $6 per ounce to a peak of $50. The exchange responded by changing the rules in the middle of the game. They raised margin requirements dramatically, making it prohibitively expensive to hold large futures positions. They restricted trading to liquidation only, meaning you could sell but not buy. They coordinated with regulators and the media to portray the Hunts as dangerous speculators manipulating markets. And they ultimately crushed the position on what became known as Silver Thursday, March 27, 1980, when prices collapsed and the Hunts faced bankruptcy. The same playbook is already being deployed right now, and you can see it happening in real time. Industry sources who spoke to Kitco News and Reuters are reporting that COMEX officials are actively discussing margin requirement increases for silver futures contracts. These discussions typically happen behind closed doors before official announcements. But when multiple sources start leaking the same information, it means the exchange is preparing to act. Most analysts expect an official announcement within 7 days, probably time to try to cool off the physical premium spike before it gets completely out of control. But here's the critical difference between 1980 and 2026 that makes this situation far more dangerous for the banks and far more potentially explosive for prices. The Hunt brothers were 2 guys using leveraged positions concentrated in one market. You could target them specifically, change the rules to liquidate their positions, and restore order. The demand for physical silver today is completely decentralized across hundreds or thousands of different players. You've got sovereign wealth funds from the Middle East and Asia accumulating metal. You've got central banks diversifying reserves. You've got retail investors across the United States, Europe, and Asia buying coins and bars in unprecedented volumes. You've got industrial users pre-buying inventory because they're terrified about supply chain reliability. There's no single throat to choke, no concentrated position to liquidate, no way to change the rules that makes everyone simultaneously back down. If COMEX raises margin requirements, it might shake out some speculative traders, but it won't change the fact that physical premiums are at 15 to 20%, and dealers can't source inventory. If they restrict trading to liquidation only, that just confirms to the market that the paper system is broken and accelerates the flight to physical. Every tool the exchange has to restore order just validates the thesis that paper and physical have divorced permanently. The People's Bank of China, which publishes monthly updates on their official reserve holdings, reported adding gold to their reserves throughout 2025, but notably declined to disclose their silver holdings in recent reports. China is both the world's largest producer and largest consumer of silver, and their January 1st export restrictions on refined silver weren't random policy. According to analysis from the China Mining Association, the restrictions were explicitly designed to ensure domestic supply security for strategic industries, including solar panel production, electronics manufacturing, and military applications. When a country that produces 65% of global refined silver decides to lock down exports, that's not a temporary disruption. That's a permanent shift in supply chain architecture. The London Bullion Market Association, which oversees the wholesale physical precious metals market in London, has been notably quiet about vault inventories and delivery conditions. But traders who work in that market, speaking to Reuters and Financial Times on condition of anonymity, describe a situation where physical silver for immediate delivery is commanding premiums above spot that nobody has seen since the 2008 financial crisis. When London wholesalers who typically trade in 1,000-ounce bars between institutions, start experiencing tightness, that's a signal that the entire global supply chain is stretched beyond capacity. You need to understand that silver is fundamentally different from gold in one critical way. More than half of silver demand comes from industrial applications, not investment demand. We're talking about solar panels, electronics, medical equipment, automotive sensors, and dozens of other critical technologies that can't function without silver. When investment demand surges at the same time, industrial users are competing for limited supply. You get a squeeze from both sides. Industrial buyers will pay almost any premium to ensure their production lines don't shut down, and that creates a floor under physical prices that's completely independent of what paper contracts trade for. The 8 largest banks that the Bank for International Settlements tracks in their derivatives data are now caught in a trap of their own making. They issued hundreds of millions of ounces worth of paper claims, assuming they could always source physical metal if needed. They're now discovering that assumption was wrong. China has locked down supply, retail investors are draining dealer inventories, institutional players are standing for delivery, and industrial users are competing for every available ounce. The DOJ investigation into Powell means these banks can't rely on Fed credibility to keep the paper game going, and every day they delay covering their positions, the premium gap widens and their losses compound. This isn't theoretical. This is happening right now in markets you can verify yourself. Call a major dealer like APMEX or JM Bullion and ask for a quote on Silver Eagles or generic rounds. You'll hear the same story everywhere. Limited inventory, high premiums, uncertain delivery times. That's not how commodity markets are supposed to function when your screen says the metal is available at 85 bars. This is what market breakdown looks like in its early stages before the real panic sets in. Now let's talk about where this goes from here, because the mathematics of this situation lead to outcomes that most people aren't prepared for. I'm going to walk you through 3 scenarios based on how this premium gap evolves, and I want you to understand that these are not wild speculation. These are straightforward calculations based on the mechanics we're already seeing play out in real time. Conservative scenario first. Let's assume the premium gap stabilizes at around 17%, which is roughly where we are right now with Silver Eagles trading at $100 while spot shows 85. If spot silver continues its structural rally and reaches $100 per ounce, which technical analysts are targeting based on breakout patterns, your physical Silver Eagle would trade at 117. That's not a typo. You'd be looking at your screen showing $100, walking into a dealer, and paying $117 for a 1-ounce coin. This scenario assumes premiums don't expand further, that supply chains stabilize somewhat, and that we don't see additional shocks to the system. That's your best case outcome from the current situation. Now the stress scenario, and this is where things get genuinely frightening for anyone holding paper claims. There are persistent rumors circulating through the London wholesale market about potential delivery issues at the London Bullion Market Association vaults. The LBMA handles enormous volumes of institutional precious metals trading, and if delivery squeezes that we're seeing in retail markets start appearing in wholesale institutional markets, the premium gap could explode to 50% or higher. We saw glimpses of this possibility with Japan's 80% premiums, which tells us the infrastructure for extreme dislocations already exists. In this scenario, if spot shows $100 on your screen, you're paying $150 or more for physical silver by March 2026. The paper price becomes completely irrelevant because nobody trusts that contracts will actually convert to metal when needed. Let me give you 3 specific trigger points to watch that will tell you which scenario we're heading toward. These are the technical and fundamental markers that will determine whether this stays manageable or spirals into something unprecedented. Trigger point 1, watch silver's spot price at the $80.50 level by January 20th, which is exactly 1 week from today. This price level represents a key support zone based on the breakout structure that formed when silver cleared its previous resistance at $75. If silver holds above 80.50 through January 20th without breaking down through that support, it confirms this is a structural rally with momentum behind it, not just a short-term squeeze that will fade. Technical analysts at firms like Crescent Capital, who focus on precious metals, have identified this level as the make-or-break point for continuation higher. A hold above 80.50 means we're likely heading toward $90 and then $100 on spot prices, with physical premiums widening the entire way. Trigger point 2, watch for physical premiums to hit the 25% threshold. Right now, we're at 15 to 20%, which is extreme but somewhat manageable. If you start seeing American Silver Eagles consistently quoted at 106 or higher while spot sits at 85, that's your signal that we've entered bubble danger zone. At 25% premiums, you're seeing full-scale panic buying where price no longer matters to buyers. They just want metal in hand at any cost. This is the psychological threshold where the paper to physical divorce becomes irreversible in the minds of market participants. Once premiums hit 25%, they tend to keep expanding because the premium itself becomes proof that the paper market has failed. Trigger point 3, the gold to silver ratio breaking decisively below 50. As of today, this ratio sits around 85, meaning it takes 85 ounces of silver to buy 1 ounce of gold. When silver enters mania phases historically, this ratio compresses dramatically as silver outperforms gold on a percentage basis. If we see the ratio break through 50 and hold below that level for more than 3 days, you're looking at face-melting rally potential that could take spot silver to $120 or $130 by April 2026. That kind of move would represent silver roughly doubling from current levels in less than 90 days, and it would trigger a cascade of short covering, momentum buying, and panic purchases that feeds on itself. The ratio breaking 50 is your signal that we've transitioned from a structural rally into genuine mania. Here's what makes this situation so mathematically inevitable. The Federal Reserve is trapped in a position where every possible move makes the situation worse. Let me walk you through the logic that Powell and his colleagues are facing right now, because understanding their impossible position helps you see why this has to play out the way it is going to play out. Option 1, the Fed hikes interest rates to defend the dollar and restore confidence in monetary policy credibility. But raising rates when the Fed chairman is under criminal investigation would be seen as a desperate move to prove independence, and it would accelerate the flight to safe haven assets, including precious metals. Higher rates also increase the cost of carrying government debt, which worsens the fiscal situation that's already driving investors toward hard assets. This option makes the problem worse, not better. Option 2, the Fed cuts interest rates to provide liquidity and support markets, but cutting rates now would be interpreted as complete surrender, an admission that they can't raise rates because the system is too fragile and the political pressure is too intense. It would confirm every fear about Fed independence being compromised, and it would trigger even more aggressive moves into gold and silver as protection against monetary debasement. Foreign central banks holding dollar reserves would accelerate their diversification into hard assets, and the dollar would weaken considerably. This option also makes the problem worse. Option 3. The Fed holds rates steady and tries to maintain the status quo, but the DOJ investigation makes that impossible because markets can no longer trust that Fed policy is being set based on economic conditions rather than legal pressure. Every statement Powell makes, every press conference, every policy decision will be viewed through the lens of, is he trying to help his legal situation? The credibility needed to maintain confidence simply doesn't exist anymore. Markets lose confidence, and money flows out of dollars into tangible assets. This option makes the problem worse by default. The only genuine path forward that could restore stability would be full exoneration of Powell by the Department of Justice, a clear statement that the investigation was dropped, no charges will be filed, and Fed independence is restored. But that's looking increasingly impossible based on political dynamics playing out right now. Republican Senator Tom Tillis has publicly stated he will block all Federal Reserve nominations until the matter is resolved, which means Powell can't even be replaced cleanly if Anthropic wanted to move past him. The investigation grinds forward, the uncertainty compounds, and every day that passes without resolution drives more capital into hard assets. Think about the broader implications of what this means for our monetary system. The Federal Reserve's credibility is the foundation underneath every dollar in your bank account, every treasury bond held by foreign governments, every futures contract traded on U.S. exchanges. When that foundation cracks, the entire structure built on top of it starts to shift in ways that can't be controlled by policy adjustments or regulatory changes. We're watching a confidence crisis in slow motion, and silver is the canary in the coal mine because its paper-to-physical ratio makes it the most vulnerable to delivery squeezes. You need to understand that I'm not telling you this to create panic or fear. I'm showing you the mathematical and logical progression of events that are already in motion, so you can make informed decisions about protecting your wealth. The people who get hurt in situations like this are the ones who don't see it coming or who wait too long to act. The people who navigate it successfully are the ones who understand the mechanics, watch the trigger points, and position themselves appropriately before the crowd realizes what's happening. If you own paper-silver contracts through ETFs or futures, you need to seriously consider whether those contracts will actually convert to physical metal when you need them. The SLV ETF holds silver in trust, but the prospectus specifically allows them to settle in cash under certain circumstances if physical delivery becomes impractical. Your futures contract gives you the right to stand for delivery, but if 355 other people have claims on the same ounce, how confident are you that you'll be the one who gets it? These are questions you need to answer now, not when the squeeze intensifies. If you're trying to buy physical silver, understand that premiums could go significantly higher from here before this resolves. Waiting for premiums to come down might mean you miss the opportunity to acquire physical metal at any price. We've seen this pattern in previous precious metals squeezes. Premiums expand, inventory disappears, and then premiums become irrelevant because there's simply nothing to buy regardless of what you're willing to pay. The decision isn't between paying current premiums or lower premiums later. It's between paying current premiums or potentially having no access to physical metal at all. This is the moment where our financial system's promises get tested against physical reality, and physical reality is winning. The screens can show whatever price the paper market determines, but if you can't actually buy the metal at that price, the number is fiction. We're discovering in real time that decades of fractional reserve precious metals trading created a system that works perfectly until the day it does not. And January 11th, 2026 might be remembered as the day it stopped working. We have crossed the Rubicon. Silver for $100 is just the beginning. When the investigation against Powell reaches the court, the paper dollar will begin to look for the bottom and real assets for space. What we are seeing today, January 13th, is not a temporary jump. It is a complete reset of the global financial hierarchy. Now you have a choice: to believe the numbers on the screen that the banks draw to keep you in the system, or to believe the reality, where the physical metal disappears from the market. When the difference between paper and reality is $15, it is an alarm signal. When it becomes $50, it will be too late to buy because there will simply be no sales. I continue to monitor every step of the Ministry of Justice and every gram of silver that leaves the vaults. If you want to know which banks will fall into the 356.1 trap next, subscribe to this channel right now and turn on notifications. Events are developing too quickly. Pandora's box is not just open, it is empty, because all the real silver is already in the hands of those who managed to do it. Don't let your capital remain just numbers on a fading screen. Act now. See you in the next emergency issue.